You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, welcome back, everybody. We are back for another episode.
Yes, we are.
Yes, we are. We are indeed. Hamish, what's going on? How's Melbourne? How are you?
Melbourne's good. It's getting a little bit warmer, so as it gets warmer, my mood goes up.
It's so good.
I don't know.
The days just get a little bit longer.
Yeah, what's that? I don't know what the condition's called, but I've got that thing where in winter
Sads.
I'm just being depression. No, I've got that thing where when it's freezing cold, when it's freezing cold, I'm so sad, and when it's hot, I'm happy. So.
No, it's not SADS. What is it? SADS is the sudden adult death. No, it's not SADS.
Hopefully I don't have that.
No, I hope you don't have that either.
Yeah. Anyway.
No, it's seasonal affective disorder.
Yeah, that's it. That's the one.
Depression related to the changes in the season. So it's not SADS. It's sad.
Okay, it's just sad.
One letter, big difference. Sudden arrhythmic death syndrome is SADS. I don't want you to have that. I think Is that the one where? I think that's the one where you can just see like soccer players like running around on the pitch and then they just fall over and they're dead.
Really?
Yeah.
Wow.
Like I don't want to start this podcast off on the wrong foot, but and I don't want to. I think there's some like YouTube footage of like athletes that are just
that's crazy.
Maybe don't. It's a bit grim. I don't want to recommend you guys go and watch that. But
on a lighter note, yes. We have questions on Spotify now. So if you're listening on Spotify, you don't have to go to the YouTube version. If you have questions for next week, you can just go below. Just scroll down a little bit on the episode, and you can ask your questions there. So we'll pull questions from both YouTube and Spotify. So don't worry if you're listening elsewhere or you're watching on YouTube. We'll still go to the YouTube comments to get questions, but you can ask on Spotify now, so you don't have to. It's a little bit more native.
I've never done that before. I don't even know how it works.
Yeah, I checked it. I can't remember exactly where it was, but I think if you just, while you're listening to an episode, you just scroll down where the lyrics usually are for a song, and there should be an option there to ask your question. So yeah, there's no like comment section or anything, so you can't see your question. It'll just get submitted to us privately. But it will. We'll still be able to see them and compile them all together. So if you want to do that, we're always taking more questions. So feel free to go ahead and do that.
Yeah, absolutely.
What if we've got we've got our monthly inflation news today. So we're back on, but it's positive. It's good.
It is positive.
It is very good.
It is actually.
We'll talk about that. Yeah, I'm not being sarcastic for once. I think the last few times I've been like, and the numbers are great. 9.1%.
Where's our fear-mongering at?
What are
we going to fearmonger over this week, Hamish? We can't do it over the inflation data.
Yeah, we're gonna have to twist something negatively. Yeah, we're gonna have to. Otherwise, no one will listen.
Disney's was positive as well.
Disney was great. So Disney earnings. We'll talk about Disney earnings. Pretty good.
DeliveRoo earnings weren't very good, and Elon Musk. Oh, we hate Elon Musk, just like the rest of the world. We can twist that real negative.
He's just letting everybody down, isn't he?
He's letting us all down. He's not working hard enough.
No. I saw that picture on the yacht. He's taking too many days off.
Oh gosh, poor guy. He goes away for literally like one day.
Yeah, it looks like that was the first time he'd gotten sun in like 10 years.
Pasty boy.
Yeah.
But
anyway,
no body shaming in this podcast, Hamish.
No, I'm not body shaming at all.
Oh, I think you are.
I was just saying it's good that he's getting sun. I think it's good to step out and touch some grass.
I'm just trying to get you cancelled, mate. I'm just trying to cancel you.
Yeah. It'll
anyway,
one day.
There's some stuff to talk about. Oh, can we before we launch in? That meme stock from last week.
AMTD.
Yeah. What happened to it?
Yeah, so
I saw it went down.
Yeah.
It went down, right? But I don't know how much.
It went down quite a lot. I think you've got it here. We did an over under. Would the market cap be over or under 70 billion? You said over, I said under. As of Thursday, as of today, but you're listening to this on Saturday probably. It is 40.3 billion. So it's down. It is down 92% in 9 days. So
it's down 92%.
Yeah, so it's 92% on sale. So
absolutely,
grab a bargain while it's available.
It went up to fair value.
yeah, fair value, the size of Meta with revenue of 25 million. So I mean, it came down. You never really know what's going to happen with these speculative companies. Sometimes they just go more insane than you expect, and sometimes they do what they should do. And I mean, look, it's still got a market cap of 40 billion for a company, again 25 million in revenue, so even that is kind of insane. But there you go. It just collapsed pretty rapid speed. So there you go.
There you go. Also, should just update everybody. I'm going to be away a little bit, so we're going to have a special podcast for not next weekend.
Not next week, the week after.
The week after.
Yeah.
So next weekend will be normal.
Yeah.
And then the week after, I'm going to Fiji. Very nice.
Oh, I'm so jealous. That'll be great. Do you know what the weather's like there at the moment? I'm sure it's insanely hot.
Yeah, I don't know. I honestly haven't looked. It's like I'm in that stage where I'm so busy that anything past like 4 or 5 days ahead, I'm just not even thinking about yet.
Yeah.
It's
Yeah, I feel that. Yeah.
Like I got to go to Melbourne tomorrow. Then I'm coming back. I'm hiring another person at the moment. I got to make these videos before I leave. We got to record that podcast. So it's like all these things are just adding up.
Yeah.
I just haven't even thought about it. I'll think about it when I'm on the plane, I guess.
Yeah. Yeah. Hopefully you get a chance to just actually take a break and just kind of, set yourself up before you go so that you can just fully relax and you're not like, I wish I'd done this or whatever. That's
always my strategy. The only thing that catches me out is the fact that we do the regular podcast, but that's fine because I enjoy it.
Yeah,
but I try I'm trying now to just like push really hard to get myself ready to go. So I can actually just peace out for a week and a half and not really think about anything. But we'll see how we go. Anyway, that's my life.
With
how's your mum? How's your dad?
They're going well.
Going all right. Yeah.
How about you?
How's your dog?
Yeah, she's good. She's still loud, but she's going. Actually, she was a bit sick earlier in the week, but she's on the mend. So
on the mend. Good.
Yeah.
Good.
Yeah. No, she's going well. Yeah.
Anyway, is there anything else we can talk about that's not investing related that can annoy people that have just come for the latest news?
What else has happened?
You got a fresh trim there.
I did. I got a haircut.
Nice.
So yeah,
nice haircut.
Yeah. When are you getting a haircut?
When am I getting a haircut? Yeah, never. No, I don't know. Actually, I'm so over having long hair. It's just a pain in the butt.
I actually really dislike having long hair, but I'm just so lazy. I just enjoy getting it cut relatively short and then just growing it out for like 4 or 6 months and then getting another haircut.
Yeah, fair enough. Haircuts are just a pain in the butt. No, I haven't had a haircut in years. It was a pandemic thing and then it just kept going. And now all of a sudden, what do you know?
Yeah.
I've got really long hair. People have been commenting. They've been saying I should do one video with my hair down.
Yeah.
So
I used to do that. And then I look back at those videos and I just think, I really shouldn't have done that.
I'll do one video with my hair down right before I chop it all off, maybe.
Yeah, okay. Anyway. That works.
All right, we've wasted enough time, Hamish.
Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your brokers or doing it manually by entering them in one by one, or you can go to your broker's website, download the trades using Excel and import them in. Super easy. Once you do that, it will track all of the different types of gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, diversity, as well as use that tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. Use that link, sign up to a free plan, track up to 10 holdings for as long as you want. Or you can also use that link to sign up to a premium plan, and you'll get 4 months off a yearly subscription if you use that link. And of course, as always, thanks to everyone who's used that link and is supporting this podcast.
Yeah, absolutely. All right. First story off the bat. Let's talk about inflation because it's actually not too bad.
It's actually pretty good. Yeah. It's
pretty good. It's all relative, isn't it?
Yeah. It is all relative. It's good compared to last month, which was absolutely horrendous. And then we don't want to look back at that.
Oh dear.
No, so the annual rate came in at 8.5%, which was down for the annual rate, which was down, of course, from last month, which was 9.1%. So, of course, inflation has peaked. No more worries. It's all gone away. No, but it is, of course, a relief to see it come down somewhat at least. Month over month, this is the big news, 0% inflation. Zip. Nada.
Oh, okay.
So last month, there was a 1.3% inflation in 30 days. In the last 30 days, inflation prices haven't changed on average. So
easy.
That's massive. So yeah, even though the annual rate, of course, is still very, very high, the near-term data that we have is extremely low. The only kind of caveat I would say, just to play devil's advocate to people saying this is a really, really good news, is it's just a month. And if we just combine it with the month before, so 60 days, on average, there's been a 0.6% compounded increase. So just to put that in perspective, yes, this month is incredibly great, but just a month before was very, very, very bad.
That's true.
So look, it is what it is, but everyone's, of course, hoping that this is the beginning of a more sustainable decline. You might remember back in April, which is only a couple months ago, there was a 0.3% monthly increase, and the annual rate declined for 1 month, and then it kind of resumed growing. So, we can never just use 1 month's result as an indication, but we're hopeful.
But hopefully we are coming down. One thing that I found interesting that I just wanted to add in here is that I was listening just to the Tesla shareholder meeting, which was last week, a few days ago.
Must have been last week, yeah.
And Elon Musk was asked about this as well, and he said that he sees a lot of people are just like, oh, what does he know? I made a quick video on the Clips channel being like, oh, this is what he thinks about the economy right now and inflation. People are like, oh, he should just keep his, head out of things that he knows nothing about.
He's out of touch.
Stick to building cars or buying Twitter or whatever. But you got to remember that like a guy like Elon Musk, despite he's not a Ray Dalio, for example, but he does have a lot of insight into the global supply chain.
Oh yeah,
things like that. He runs a legitimate large car manufacturer. They have a lot of suppliers from all around the world. So a lot of them from China. So it's like he actually does have a bit of insight into things like inflation. And so that's why I found it was actually interesting listening to him on the during the shareholder meeting, saying that he does believe that inflation has peaked and he thinks he'll see it coming down towards the end of the year.
Right.
So yeah, take that for what you will. But I think that that's been the trend, and I can't think of other examples off the top of my head. I don't know if you've been hearing with like any other conference calls or anything, but there have been some pretty key business execs that have been coming out saying that they think that inflation has peaked and that it should trend down for a while now.
Yeah, I don't think I have any examples. No.
Yeah, I can't think of any examples.
That is kind of the general consensus, at least at the moment. That's kind of the general consensus. And if we look at the individual contributors to, in this case, we're not talking about what drove inflation during the month, but actually what helped it to come down. We do get a bit of an insight into maybe some of the reasons why towards the end of the year we potentially could see inflation coming down and not, revisiting the 9.1% that was seen last month. The biggest contributors: fuel oil was down 11%. So oil coming down massively after, it's still elevated, but it's coming down somewhat and, at a reasonable rate. Gasoline, again, in that same kind of category, down 7.7%. Utility gas, another energy source, 3.6% down. So energy is very much contracted considerably.
Yeah, it's turning the other way. Because it was only last month that we were saying things like it was up 11%, up 7.7%, up 3.6%. So
and all of these all of these are up, I think, well over 100% year over year. So that's why the year over year figure is still very, very high for inflation. But 11% drop in the price of oil is not, that's not small. That's pretty considerable. Food was up 1.1%. So food continued to kind of have the same increase that it's had for many months. It's actually been like 0.9, 1.1, 1.2, 1% per month. So it kind of continued humming along. Nothing really changed there. But it is kind of important to remember that food is impacted by energy, but probably takes longer for the decreases in oil prices to flow through to things like the manufacturing process, to the delivery expenses, things that could very well be under contract, under fixed prices for 30 days or 60 days. So
true.
That's just something to keep in mind. We may very well see food prices kind of follow energy just, with somewhat of a lag. Although I'm no economist, so I'm sure someone can...
Hamish Dalio.
Yeah, exactly. My very, very...
But that makes sense.
My very uninformed general opinion on that, and but we never know. Ultimately, there could be another oil shock. That's the reality, right? Everyone has, consensus opinion. This is what should happen given the normal course, but the inflation crisis we're in right now is not... It happened out of a shock, right? So there could very well be more shocks. The shocks that existed could relieve themselves. We don't know, and we can't make predictions. We can only, hope to see.
Use that young investors tagline, Hamish.
Yeah, well,
we'll have to wait and see.
We don't know, but we'll tell you all about it. Is that the one?
We'll tell you when it happens. We will wait and see. But honestly, just to go on that, nobody knows. Nobody knows what the hell's going to happen.
No.
You look at all the macro economists. It's just they make so many predictions. 99% of the time, they're all wrong.
Yeah.
In some way, they might get the trend right. I think that they could probably suggest what the trend is going to be.
Yeah.
But we think it's going to go. This is going to go up 5% next month. This is going to go down this percent. It's like they always get it wrong.
It is a funny industry, and it's the same as stock analysts. They make so many predictions, and so many of them are wrong. It's just it's kind of a weird...
literally all of the I would say pretty much. So that's the funny thing is the analysts is just going off on a tangent. It's crazy how analysts, they'll make an expectation of what the stock's going to do, and then if the stock beats or misses the analyst's guess, that moves the company's stock price.
Yeah.
It's that's totally backwards.
Yeah.
It's not that, the company didn't do what the analysts thought they would. It's the analysts just got it wrong.
I don't know. It's just a weird market where everyone relies on this group of people who some of them would have very good track records of making some predictions, but it's analysts is kind of a... I don't know. There's a lot of people who do stock analysis.
It's so silly because they're analyzing the next 3 months. I don't get it. The industry is so short-term focused, but I don't know. I'd like to put in a ban of all short-term prognostications.
Yeah,
you can only guess. You can only make a prediction on where they'll be in the next 5 to 10 years.
Yeah.
You're not allowed to guess any sooner than that. It's illegal.
It's illegal. I predict that in 3 months. Knock, knock, knock. FBI, open up.
Sorry, mate.
Gotta make secret predictions under the table.
But it's so weird because they make these short-term predictions, but it's who even cares?
Yeah.
It's I think in the next 3 months this is going... Who cares? It's so inconsequential. To put things in perspective, right? The stock market's been around for a long time. What happened to the S&P 500 in Q3 1971?
Oh, not Q3 1971. That was a shocker. That was awful.
Yeah,
Don't
all
bring.
right, shut
That's
up.
a bad example, Brandon. That's a bad example. No, I'm kidding. No, but
No
you're right
one-
though. It's
like-
no one remembers a single quarter, like because
No.
it doesn't really matter in the scheme of long term investing. So yeah, no, you're
Yeah.
right. I'm just kidding.
It's so dumb. It's so dumb.
Yeah. Anyway,
Anyway,
core inflation,
sorry.
which excludes food and energy, was up 0.2% month over month. So pretty modest increase for the core segment. Big drivers were new vehicles up 0.6% and transport services down 0.5%. And then in the CNBC article, they kind of just pointed out some interesting inflation items. These are year-over-year figures. Coffee is up 20% year-over-year, so it's been one of the big ones. It's why my expenses have gone up so much. I drink 10,000 coffees a day. So it's half of my expenses.
True, actually, you will love it. Over in America, you're like, oh man, just like, where's the Starbucks, eh?
Yeah. You would have seen it. I get up and I'm like not functional. I'm not functioning at all until I've had a coffee. And then the second coffee is kind of like the first coffee for most people, if you know what I mean. The first one just gets me the baseline.
It gets you normal.
Yeah. Butter is up by 26.4%. Another big one. Eggs, 36%. So everyone who eats eggs is seeing a big
That's
increase.
very straight. I don't know. I don't know the numbers deep enough to understand. It's probably some supply chainy thing, but
yeah.
Coffee, butter, and eggs.
There you go.
There you go.
So
It's a big increase.
yeah,
Those chickens, they aren't laying. Who knows?
yeah. Most of the inflation's just breakfast.
That's great. So if you just skip breakfast, then you guys you'll be fine.
Then you're fine. Yeah,
You're fine. Yeah. Coffee, butter, and eggs. That's quite funny, actually.
All right. Yeah, and I mean, look, that's pretty much it. The market loved the news. It came in as you just spoke about before. It came in below expected inflation, so the market was very, very excited by that. And since inflation is seemingly cooling, I think it's very likely that next month, when the Fed does a rate hike, we will probably see the 50 basis points and not 75. Powell has said he could go either way. The way he described 75 was they would do it if necessary. So that kind of gives me the feeling that a lowering of inflation would probably indicate that he doesn't think it's necessary to do a 75. But again, we don't know. So we'll see what happens. But it will be interesting to see if they begin to kind of slow down because the year-over-year inflation rate is still very, very high. The Fed does not want to make the mistake that was made in the 70s where inflation declined, they stopped hiking, and then inflation had a second wave. The first time in the early 70s went to 12%, then dropped back to about 5% inflation. They cut back interest rates, and then inflation went from 5 to 15, and they had to do interest rate increases again. So I'm kind of the opinion that I'd like to see consistent interest rate increases until we get back to 1 to 3%. But who knows? We'll see what happens. It looks like they very much they're looking for any excuse not to raise interest rates. So if we get a couple of months of persistent declines, I think we'll probably see the rates cut back, even if inflation is high.
Yeah, the vibe I got from Jerome Powell out of that last interview, the press conference he did after the last meeting, was that they will try and not raise rates if they can get away with it. But I do agree with you. That's a good point that you raise. You don't want to do too little.
Yeah, that's like really the big concern right now is doing too little, I think.
Yeah. And I think you raise a good point that while this month the inflation's going down, it's still very high.
Yeah.
So do you just keep punching them with 0.75% rises?
Yeah.
Or do you just take one step back, one notch back, and just see what happens?
Yeah.
I mean, who knows? But I think they'll probably I think I agree. They'll probably do 0.5.
I mean, some people are scared that we'll push ourselves into deflation if rates go too high. But honestly, with inflation being 5-6% last year, stacked on top of 8% this year, so 13-14% over the past 2 years, I think there's a bit of wiggle room for a little bit of price declines if that has to happen. So it is what it is. But
yeah, hopefully the supply's all good as well.
Yeah.
Hopefully we can get through all this supply drama. But yeah, we'll see.
Continuing to be issues, but improving, hopefully.
All right, that is US inflation.
Where do you want to?
There we go. I spoke about Elon Musk a little bit before. Can I quickly just get in with this story?
What did
Elon Musk has stirred up a little bit of controversy. I feel like you either love Elon Musk or you're looking for because he's always putting out like, oh, I'm doing all this good stuff for humanity, you know, blah blah blah. So it's like you either love him and you're all aboard, you know, the Elon Musk train, or you're looking for inconsistencies and being like, do you really mean what you say, kind of thing. Anyway, so bit of drama because he's always been, for example, in this, he's always been the person that's like, look, I'm never selling my Tesla stock, you know, I'm going to be going down with the ship, you know.
Yeah.
And this week, and I got to give tip of the cap to Sawyer Merritt on Twitter, who's just, if you follow Tesla, and you got to follow this Twitter account because he literally has all the news like before it happens. I don't know how, but it's questionable how good he is at this stuff. Anyway, Sawyer Merritt, he said Elon Musk has filed a total of 6 Form 4s with the SEC tonight, showing that he sold 7,924,107 Tesla shares worth about $6.9 billion. Wow. Weighted average price was $869.09. The sales took place on August 5th, 8th, and 9th.
Wow.
So there you go.
That's
out of the blue. And Elon has
chunk.
always said, look, I'm not selling my stock, you know.
Yeah,
I don't care, you know. I'm in it to the end, and then all of a sudden he just comes out and he sells all these shares.
Yeah,
people are going, "Hey, dude, what's going on?"
I mean, it's a lot as well because he already sold. I can't remember how much, but to put into the Twitter deal, right? So he sold a bunch there, which I presume is still in Twitter stock. He hasn't sold the Twitter.
No, he hasn't
position.
sold.
I would presume so. That money's still in Twitter, but yeah, it is interesting to see him kind of sell another packet. Is this in any way related to the deal with Twitter? It's related to
Twitter, yeah. So, well, that's what he says anyway. I mean, people like, if you were like the Michael Burry of the world, then you would say, Elon's just trying to make an excuse so he can cash in on Tesla stock. And he probably, I don't know, he probably did say that.
Oh, well.
I don't know.
Two birds, one stone.
Yeah. Anyway, but yeah. So obviously everybody's asking Elon on Twitter, dude, what's going on? Is this, you know, I'm going to sell my Tesla stock if Elon's selling. So Sawyer also asked Elon whether he was done selling, to which Elon replied, quote, yes, in the hopefully unlikely event that Twitter forces this deal to close and some equity partners don't come through, it is important to avoid an emergency sale of Tesla stock.
Got it. Okay.
There you go. And to go one step further, someone also asked as a follow-up, so if the Twitter deal doesn't close, will you buy the stock back again? And he said, yes, he will.
Okay. Right. Okay. So it's just to prevent the fact that if the news breaks that the deal closes, the stocks would have tanked, knowing Elon now has to sell a huge packet of Tesla stock, whereas now he gets the opportunity to get that cash out before the news potentially comes out to get more for his stock, which makes sense. I mean, that's just a rational decision. It doesn't really give any. I don't think it really reads too much into his belief in Tesla as a company, considering the majority of his wealth is still in the company. So, I don't know. I don't read too much into this. What do you think?
Yeah, look, I don't read too much into this. There's just always, with someone like Elon Musk, there's always going to be the two different opinions.
Yeah.
I happen to, I think that Elon is a pretty honest guy. I tend to give him the benefit of the doubt in most situations.
Yeah.
So when he says stuff like this publicly, I tend to think that, he's telling the truth. Fair enough. But yeah, I mean, there's obviously the other camp, like the Michael Burrys of the world, that'll just say this is just Elon Musk saying he's he's the Earth's savior or whatever, and then doing something else for his own self-interest or whatever. But no, I do believe that this is related to the Twitter deal, which is fair enough because the argument that he makes is, as you say, completely rational.
Yeah. And I mean, look, it's why you can't really read too much into executives selling stock, because there's so many reasons why someone could be selling. I mean, it's always good to investigate why, but if an executive's buying stock, there's only one reason why. It's because they think the stock is undervalued and they think they can get good value for it. But if they're selling, they could be selling because they think the company's going under. They could be selling because they have a deal they have to close. They could be selling to move money into a trust for a family member. Like, it could be
philanthropic purposes.
Exactly. Any number of things. It could be. So you can't just immediately, like, I think you can, to some extent, look at an executive buying and use that as, it's a good time to maybe look into this company again deeper. But selling I don't really think too much about selling unless it's like consistent selling. If an executive,
they're all selling at the same time.
If every executive just dumping the stock as fast as they can, that's probably not a good sign. No, but I've seen a couple of cases where the CEO is just always selling. Like, he'll get 10 million in compensation in stock comp, and then he'll sell 15 million that year. And then the next year he'll get 15 million and he'll sell 20 million. It's like, wait a second. You're getting so much free stock, or like not free, but for your compensation. But your ownership is still going down. Like, what's going on? Like, where are you putting that money? Which company are you putting in it? Because I'll invest in the company you're investing in. Imagine if an analyst asked that on the call. That'd be such a slam. So you've been selling a lot of stock. What stock are you buying with that? Because I'm kind of interested in that one.
We're going to take all of our funds, cash out of your company. Can you just say where are you putting your money? I want to put it in that company.
Turns out Musk has been buying Ford, and he accidentally goes over the 10%, so he has to report. No.
No, I made a monumental mistake.
Yeah, like they repurchase stock or something, so he goes above 10%, and it comes out publicly. Yeah, Musk owns 10% of Ford.
He's the biggest shareholder 10% of Ford, GM, General Motors, Stellantis.
Hang on a second, and he's short Tesla.
He's short Tesla, and he's buying big into BYD.
Oh my god. Yeah, that would be quite something.
That would break the internet. That would honestly break the internet. That would be so hilarious. And imagine what that would do if that happened to Tesla stock. Oh, that would
Tesla stock would just go to zero.
Floor. It would probably just go to zero.
They would halt it probably 10 times, and it would still go to zero.
Yeah, so probably. Oh dear. Hopefully that doesn't happen. Oh dear.
That'd be quite something.
Anyway. Tell me about Disney.
Disney.
Disney. Sorry, is that all I had to say? Yeah, that's all I had to say. Yeah, let's talk about Disney.
So Disney reported one of the later media companies to report. We've had Netflix and Warner Brothers and Paramount have all reported. So Disney's a little bit later, but also it was a really good quarter for Disney overall. Pretty strong across the board. So just to kind of go through the numbers, revenue came in for the quarter at $21.5 billion, which was up 26% year over year. Media, they segment their business into two segments now. The first is media and entertainment distribution. Revenue was $14.1 billion, so the vast majority of their business, or like 2/3, which was up 11% year over year. Going into the details of media and entertainment, because that's kind of a bundle of all of their different types of media revenue streams. Linear networks, so their broadcast and cable channel revenues came in 3% higher year over year. Direct to consumer came in 19% higher year over year, although on a month over month basis it was pretty much flat. 26% increase also in their licensing. So the biggest increase, well, D2C continued to increase at a big rate, which is great, and I'll talk about that kind of in detail in a second. But licensing as well, which is interesting to see. They continue to use their massive film studio assets to produce content and license it out to other platforms, whether it be at TV networks or to streaming services like Netflix. So that's an interesting element to their media and entertainment businesses. In terms of direct-to-consumer, which is kind of going to always be the most interesting component, I think, of these media companies going forward, as the more and more people move away from watching on TV to watching on streaming services. It's always interesting to watch, and I think Disney has one of the most compelling opportunities to succeed in this space. So it's always one that's interesting to watch. Disney Plus reached 152 million global subscribers, which was up 14.5 million quarter over quarter, which is massive. That is a huge increase in the number of subscribers. Which is great, and that's kind of the headline. You dive into it a little bit more. It's not as, I think, nice as it kind of sounds if you look into some of the details, but that is a great headline number. There was no increase in the US and Canada segment, so that's been the trend with every media company over the past couple of quarters. Netflix had a slight decline, I think, in Q1, Q2. Warner Brothers had a decline in Q2, and Paramount was flat, I think, for their US business, and so was Disney Plus. So all of them have been kind of flat in their American segment, but most of the growth opportunity is outside of the US. It's going to be in other Western markets, and then also markets that are not Western markets. They had a 6 million increase in Disney Plus International, which has an average revenue per subscriber of $6.30 per month. So just to put that in perspective, that's about half of Netflix. So it's kind of like 3 million equivalent Netflix additions. They had 8 million came from Hotstar, which is the Disney Plus in India. So most of it came from their Indian business, but that has an average revenue per user of $1.20. So each of those subscribers is worth about 1/10 of a Netflix subscriber on average, even a global Netflix subscriber. So it's about 800,000 equivalent additions.
Isn't that interesting?
Yeah, and look, that's why I said the top number is amazing, like 14.5 million. That sounds great, but 8 million of that, or more than half, is that a tiny fraction of what, like Netflix, for example, just to use it as a comparison. So it's not as 14 million versus everyone else not adding subscribers. So what? A little bit more nuance to it.
On like a financial basis, it's like 3.8. Roughly 3.8 million, like ads for what Netflix, like financially,
the
that's
14.5 million in total.
Yeah.
So
I'm looking at the
so I can give you, so Disney Plus on average overall is about $4.35 per month.
Okay.
So that's about it's about a third of Netflix's subscribers. So you could divide by 3. Yeah, like you said, it was about about 4. It'd be the same as Netflix adding about 4-5 million subscribers.
Right. Okay. Interesting.
So
but still, how smart? I mean, I know I guess the average revenue per user is not quite there, but how smart so far has been Disney's decision to tackle the Indian market.
Oh, and they've done an incredible job of it through, licensing things like the IPL, like the cricket in India, which is massive. So
really?
they've been very, very smart in how they've gone about accessing the Indian market, and they've had far more success than Netflix has. I think they're 2 or 3 times the number of subscribers in India. Again, Netflix charges more, so you kind of got to account for that. But I think Disney is definitely in front in India. And look, I think it's a good strategy. It's the same strategy Netflix used when they got started, which was price things as low as possible, get people in the door, and then just incrementally raise prices. Because they added 152 million at a third of the increase, a third of the monthly. But if they can get that monthly up and they don't lose too many of those subscribers, then they're going to be, they've grown at a much higher rate than Netflix if they can do that. So
there's no doubt that they're undercutting purposefully.
Exactly. Yeah. And then of course, Disney doesn't just end with Disney Plus. They have 2 other key streaming services. One is ESPN Plus for their sports. They added 0.5 million subscribers quarter over quarter. So pretty slow growth. And then Hulu, which has more of their kind of drama content and some of their broader Fox assets and movies and shows, added 0.6 million subscribers quarter over quarter. So again, chugging along relatively slow. Total direct-to-consumer subscribers for Disney is now 221 million. And there's a headline, of course, going around that they have passed Netflix because Netflix has 220. So technically, on an overall basis, Disney now has more subscribers. Although, as I kind of...
Hamish, it's okay.
Yeah, I know.
How does that make you feel?
I was wrong.
Let's talk it out.
This
Let's
is
talk it out. Do you feel okay?
Honestly, no. I think you can tell I've been very, very sad.
You see your eyes have puffed up. You've been crying.
Yeah.
That's okay.
So
that's all right.
You know, you can't win them all.
You can't win them all.
Yeah. So I'm just here to say I was wrong. Netflix is dead. No.
Netflix is dead. Yeah. No, interesting. But I mean, yeah, it's still very impressive from Disney, I would say.
Very, very impressive. I just think, certainly very, very impressive. They've grown very, very quickly. I think the total subscribers is going to be less comparable over time. And I mean, it kind of has been less comparable at all because, you know, different companies have different ad tiers. They have different pricing models. Some have
strategy.
Some have free trials. Some don't offer free trials. Some have year-long free trials with like telecommunication bundles. And, you know, Apple gives Apple TV Plus with every purchase of a Mac free. You get a year free. So the actual number of subscribers is kind of irrelevant. I think what's more important is, the number of subscribers, what's your sub base, but also how much you're generating per sub and what's the combination of
how
those.
it flows into the financials.
Yeah. It's not completely
we're
irrelevant.
investors at the end of the day.
I don't think it's completely irrelevant because you can, if you have a huge sub base, you have the opportunity to increase prices incrementally.
To monetize
so I don't think it's irrelevant, but just in the context of things. Just to give an example, Disney Plus has 152 million subscribers, which seems to be getting close to Netflix's 220 million, but each sub is, as I said, a third. They pay a third as much as Netflix. So on an equivalent basis, it's more like 50 million compared to 220 million. So that's kind of a more logical way to kind of look at the streaming game at the moment.
Yep. Makes sense.
What
else we got to talk about?
Yeah, there's a couple other things. The pricing strategy, they announced that in order to cover some of their increasing costs, which they had a $1 billion loss for the quarter, which was an increase from the previous year quite considerably.
Okay.
They're going to bring out an ad-supported tier for Disney Plus. Which will be,
they're doing it as well.
Everyone's jumping on board. So yeah, look, I think Hulu has had a lot of success with it, and there was actually a question I think in our questions about this. But I think an executive at Hulu said that they'd been able to get about $4 to $6 per month from ads. So that's kind of a big chunk that they can add on top of. Well, for Disney, they're going to do an $8 base plus they get ads. If they get $5 of ad revenue out of that, that's $13 per month, which is massive. So they're going to go for that. The base tier at the moment will become $11. So they're doing pretty considerable price increases. That's a $3 price increase that they're doing. I don't think Netflix has ever done a $3 price increase. So that's kind of interesting, but it will bring them more in line with Netflix's products, or at least closer. So yeah, that's kind of that. In terms of parks experiences and products, so their other segment,
yes,
parks are back in a big way. So again, they had a second consecutive year of big growth, $7.4 billion of revenue, up 70%, 70 year over year.
We're back, baby.
Parks are back.
I love to see that.
Yeah, it's great, and it's been a kind of a 2-year trend. Last year's parks segment was up over 100%. It was like 150%, and then they backed that with another 70% increase. And I think a big driver of this is international travel continuing to open up in a big way, because I think it was like 15 to 20% of their sales to their US parks are tourists or something like that. So it's quite a considerable chunk of people coming from outside the US. So yeah, all of this kind of came together for net income of $1.4 billion, which was up 54% year over year. Although they do expense all of their content spend. So, the bottom line for these companies is, you got to take it with a pinch of salt, given that they're investing a lot of money through content to gain new subscribers. So maybe spending additional money in India, for example, for cricket licensing to capture subscribers that they haven't yet captured. So they've spent the money, but it hasn't come through in terms of adding subscribers and revenue. So that's, they're essentially investing through the income statement, which makes the bottom line less of an actual profit figure for these businesses.
Cool. Nice. Disney.
Disney.
Rebounding. Love it. All right. Is that all we had to talk about for Disney?
That's it. I'll only take 20 minutes of this to talk about streaming for this episode.
Yeah. Well, I'll just say something to trigger you. It's well, I think that conclusively shows everyone that Disney is winning in the streaming space. Hamish, your thoughts on that?
You don't get it. You just don't get it. How many times?
Have you been listening to the Phil Town podcast?
No, I haven't actually. I listened to. He did a couple of episodes a while ago on Netflix. Is that what you're talking about?
He's doing so much. You can tell that he wants to sink money into Netflix.
I haven't seen any of his recent ones. I didn't find them overly valuable, honestly.
Nah, they're not.
They're very surface level.
You've gone way deeper on Netflix at this point than what I'm sure Phil has gone very deep. But what they discuss, the level they brush on the podcast, yeah, you've gone a lot deeper. But yeah. He's spoken a lot.
I'll have to check him out.
But he quotes all the same stats that you already talk about. So you probably won't get much out of it, but it'll probably be like a nice little confirmation bias for you.
Yeah.
You're like, oh, I was right.
Well, the good thing...
Yeah, he was talking about the Nielsen data of the
engagement.
Yeah.
Well, the good thing about that investment for me is usually when I've invested in something, there's a lot of analysis that agrees with that side, so you can fall into the trap of confirmation bias. Whereas with Netflix, there's nobody. I post something on Twitter and it just gets absolutely no likes. And I think now, whenever I post something and it gets less likes, it makes me feel better because I realize how far against the consensus I'm going.
Yeah. If you want to beat the herd, you can't be a part of it.
No.
All right. We'll talk about DeliveRoo. DeliveRoo is not a company that I've ever gone deep on, but I thought their earnings were interesting. It's certainly making news headlines at the moment. So DeliveRoo, losses at British meal delivery firm DeliveRoo swelled in the first half of 2022, while revenue growth slowed dramatically as the disappearance of pandemic restrictions and a rise in the cost of living dented demand for online takeout. DeliveRoo reported a pre-tax loss of £147.3 million in the first 6 months of the year, a 54% improvement from the same period a year ago, so they were even less profitable beforehand. The losses were driven mainly by increasing spending on marketing and overheads. Revenues at the company climbed 12% to £1 billion. That was much slower than the revenue growth that the firm reported in the first half of 2021, when sales climbed 82% year on year. Yeah, so we've got an 82% growth of revenue down to 12%. Deliveroo's gross transaction volume, which measures the overall sales on the platform, grew 7% to £3.6 billion, which is lackluster growth according to CNBC compared to last year when gross transaction value doubled in the first half. The company blamed the disappointing performance on challenging market conditions. The food delivery market has been gripped by the twin challenges of rising inflation and a more outgoing customer. And that's the thing, isn't it? I mean, people are cutting back. People are getting more free, just generally speaking. Geographically, everywhere is a little bit different, but generally speaking, people are getting more freedom. They're going out. Yeah. They're ordering less. They're not having to stay at home. And also at the same time, a lot of people on the flip side are just not spending money anymore because the inflation is just eating up their budget.
Yeah, exactly. And I think people are very price sensitive at the moment, and these platforms, they don't really have anything unique except different pricing. I find myself, every kind of Friday, I have some friends over and just order something on one of these apps, and it's just like a fun game. Like, okay, $8 delivery from Uber Eats. Nope. Menu log is $6. Okay, getting better. Deliveroo, $1 delivery. Let's go there. Yeah. That's literally what it is. And I think as they raise prices, which is what Uber Eats is kind of in that phase of really, their delivery fees are off the charts now compared to Deliveroo, which is really cheap now. That's the one I go to. Deliveroo will get more revenue, but their losses are probably just going to expand until they can raise prices. And then when they raise prices, there will be another app probably that's got some new venture capital money and can burn billions of dollars. And
bit that of a lose-lose, isn't it?
It's a fun industry where investors are basically funding our easy delivery of food. So it's been great. I've enjoyed the ride. It's not going to last. None of these businesses, DoorDash, DeliveRoo, Uber Eats, none of these businesses, I think Uber overall is profitable, but Uber Eats is not. None of these businesses are profitable. So they're just funding it with investor capital. And it's just new investor capital. Now it's British investor capital. So
yeah.
I think these apps are great. I'm really interested in this area because
they just don't make money.
I don't think it can work. Unless they have like drones or something and they can eliminate the human element, which is very, very expensive.
As sad as it is, that's it. You got to get rid of paying people
because
to be able to flourish.
Yeah, because it's expensive for us. It's expensive for the restaurants. The Deliveroo's making no money. The drivers are making barely any money. Like nobody's making everyone's like not enjoying the situation. It's not like there's lots of money to go around. There's so many stakeholders that are trying to get a little piece of a $12 meal. It's tough, but
that's true. That's actually a really good way to think about it. When you think about how much your order in total costs, you buy a dinner and you get it delivered or whatever, and it costs you $20-$25. And then you figure out how many people, how many stakeholders there are in that $25 and how much all of that process of, sourcing the food, cooking it, then getting a delivery driver to come pick it up. The delivery driver brings it to your house. How many stakeholders there are that need to make a profit in there? And it's like, man, that's a big effort for like $25 total.
Yeah.
It's like how is that profit when you factor in costs? It's like oof. Yeah. But interesting.
Yeah.
Sorry, yeah.
No, that's it. Yeah.
Oh, okay. I was just going to say I don't really know the space very well. So I was looking at like how does Deliveroo kind of factor in? So in the first half, they had 7.8 million users, 161 million orders, and 180,000 riders. Uber Eats, on the other hand, has over 80 million users. DoorDash has 20 million users. And Menulog is actually really tiny, but I think it's more popular in Australia and New Zealand, Menulog. Just has 3 million users.
Yeah, it's called something else. I think it's called Just Eats in the US or something.
Right. It is in a lot of different markets, but the company is.
But it does quite well, and I think it does quite well in Australia. So I'd be curious to see. I guess maybe that 3 million is just in Australia, and they're not reporting the rest. But yeah.
But yeah, you can definitely tell that DoorDash and Uber Eats are the big boys, and but Deliveroo is really quite small at the end of the day.
But as I said, it's like if you're in Australia and you're not using Deliveroo, you should actually check it out and you get stuff regularly because it is far cheaper at the moment. Right. So I wonder, is there just going to be a migration of, people moving from Uber Eats and then moving into Deliveroo, but then when Deliveroo prices get comparable to the other, they lose them again, or there's a new one that comes in. So I don't understand what the competitive advantage is.
Deliveroo only on bicycle?
I don't think so. No.
No? Okay.
I'm pretty sure no. Yeah.
Because that's where I always see Deliveroo.
I don't think so. I mean, no.
Actually, on the back of
there's
bicycle.
No way. I get food that's sometimes like a 10-minute. It must be in a car. It's like 10 minutes. Yeah. There's no way. Does one order and they're just done.
That is always the one I see on bicycles though, on the back of.
Yeah. Maybe. Yeah. I don't know. I don't know why that is.
I don't know. I don't know. Anyway, on top of all of these interesting earnings numbers, Deliveroo said it was consulting on plans to exit the Netherlands, which would mark the latest exit from a major European market for the company. The firm, which faces the prospect of much stricter gig economy laws in the European Union, previously retreated from Spain last year and Germany in 2019. However, the Netherlands represented only 1% of Deliveroo's GTV for the first half of 2022.
Yeah, wow.
So it looks like it's all systems slowing down, unfortunately, for Deliveroo. So what did their management say? Well, their management were very optimistic. Very optimistic. So far in 2022, we have made good progress delivering on our profitability plan, despite increased consumer headwinds and slowing growth during the period. We are confident that in the second half of 2022 and beyond, we will see further gains from actions already taken, as well as benefits from new initiatives. Blah, 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 blah. And then, interestingly, one of their new initiatives is just do some buybacks.
With what money?
Yeah,
So that's just the
I knew you
Ponzi
were gonna
scheme.
say that.
If an unprofitable company is doing buybacks, then it's just investors funding the repurchase of their own stock. Isn't that just a okay? Anyway, go on. Describe to me this new initiative.
That's pretty much like separate. It just says separately. Wednesday DeliveRoo said it would initiate its first ever stock buyback program, purchasing up to £75 million worth of shares from investors. However, they do note that the purpose of the program is, quote, to mitigate dilution from share-based compensation plans.
That makes sense. That's fair, I guess. Yeah. So,
imagine if they just did this monster share buyback. That's like, what company was it? What company was it? Oh, damn it. I'm so annoyed that I can't remember. They did a massive share buy. Maybe it was even Netflix. They did a massive share buyback plan and they were just burning money. No?
I don't think so. I can check.
In one quarter, they did do a share buyback and I was really confused. I think we were both confused at the time because they were just burning money.
Could have been.
But anyway, it happens sometimes, like these unprofitable companies pop up and do a share buyback and we're both sitting here like, what?
Huh?
Yeah. Like, can't you just use that money to just, do this with your business? Like make your business bigger?
Profitability.
Anyway, whatever. Make some money.
Yeah.
Any thoughts on the buyback or nah?
No, not really.
It's
on
not
the,
really
on the
that
buyback,
eventful.
but yeah, I mean, on the withdrawing from Europe, it is just interesting because it's like a lot of places are deciding on whether to introduce laws where the drivers are employees, to have better pay for them. It just seems like as soon as that happens, it just completely destroys it's like the business model is hanging on by a thread. And as soon as that happens, it just doesn't work, which is unfortunate because, you obviously you want people to be paid, how they want to be paid, or what they deserve. So that's
actually
tough,
a new term for me that I ran into, a gig economy. I had to look that up because that was a new term that I hadn't heard.
Yeah,
it's a free market system in which temporary positions are common and organizations hire independent workers for short-term commitments. So exactly like what we're talking about.
People have mixed opinions about that. It's obviously allows people to have, side hustles and flexibility with work, which some people prefer. But there's downsides. There's no consistency, no like sick pay.
Annual leave, all the benefits and that you'd expect from
especially if
worker.
Jobs that used to get all those benefits and now for the employer's benefit because it's cheaper are converting those jobs into contracted jobs where those benefits don't apply. I can see certainly how some people in certain industries would find that frustrating. But I mean, there's both sides to the argument on gig work.
Yeah.
I think it's always good if people can do small amounts of work easily without massive regulations in place, like for us to be able to hire people to do contracted work without having to go through every single loophole required to hire someone as an employee and the tax complications and super and all of that associated with it. But yeah.
Yep. I'm with you. It's interesting.
Yeah.
All right, that's all I had to talk about for DeliveRoo. Should we move on and just do a couple questions, maybe Q&A?
Yeah.
Just to round out the podcast. Remember, you can submit your questions on Spotify or over on the YouTube channel. So just go to the latest YouTube upload and just drop us a comment. Ask us whatever you like, discussion topics, whatever. Hit us up and we'll try and get to it at the end of the podcast when we have a couple of minutes. But we always tend to run quite long.
And do our best.
We always do like one question because we'd like to do like 3 questions each week, but we just don't get to it. Anyway. We got a good one?
Yeah, I don't know.
Should I ask you this one or did we cover it, the one about Hulu?
Oh, yes. Yeah, you can ask
So
it
the
then.
question was, so we'll just answer it specifically. What do you think about Netflix potentially cannibalizing full subscribers into their ad/subscription model and then overall revenue declining? How do you know if they'll make as much per ad, per sub, as they do per full sub?
Yeah, well, the simple answer to that, or the short answer is we don't know. Obviously, the executives, the management team wouldn't be doing it if they thought that it would result in an overall decline in revenue. So they obviously think it'll be accretive, but we don't know. Really, ultimately, all we can look at is kind of how other streaming services have done. And as I mentioned earlier, Hulu, I think it was an ex-Hulu executive had said that they were getting about $4 to $6 per month from ads. So, if Netflix charges $8 per month and you add the ads on top of that, it would be far in excess of their average. It would be adding to their average revenue per subscriber. Obviously, if someone cut from a premium subscription to that, it would be negative for the business. But if people cut from the low plan to ads, it would not. And that's more likely where there's going to be movement. Disney's doing $8 per month plus ads. I think it's very likely Netflix will do 8 or 10, and we'll see that early next year. But if they do 8 or 10, then I think it's very likely that it will be able to generate more revenue than their basic plan at the moment. So that's kind of my thoughts on it. But we don't know. We'll have to see how it plays out.
All right.
Do you have
should just maybe this top one or?
Yeah. Okay. Can you talk about what to look for in a balance sheet? Looking at Voyager, it isn't clear to me why it is imminently going bankrupt, or well, now it went bankrupt. While other firms with low current ratios and negative cash flows keep chugging along.
Yeah, so I was interested, the way I took it is when we're talking about potential bank, how can you kind of see a company going downhill? I think it's obviously a multi-factor, and you don't just look at the balance sheet. I guess it's multi-factored.
Yeah.
But I mean, I've just written down a couple of things that I would look for, like cash going down over time is pretty obvious from the balance sheet that something's not right. You could, just in my research, of course, this can be masked because they can do a couple of things to raise cash. So if they're taking on debt at absurd rates, if they're selling assets and trying to replenish their cash, as we've spoken about with companies like Hertz when they do Hail Mary capital raises, that can kind of keep them going. But I guess cash going down over time is a good one. The current ratio, current assets over current liabilities. So if they have very little in current assets, they have a lot in current liabilities. That's a worry. I guess debt to equity rising a lot over time. More and more debt, less versus less and less equity. Retained earnings not increasing. But then apart from that, you can look. That's just balance sheet. Can you think of anything balance sheet wise?
Beyond
that,
you've pretty much given all of the main ones I can think of. Just on Voyager specifically, so what essentially happened was they had loans out to 3 Arrows Capital, and those loans went bust. So they had assets essentially on their balance sheet that became worthless, right? So that it looked like they had enough assets, but they didn't. I haven't looked at Voyager in detail, so I don't know if they had actually listed who their loans were out to. Usually if they have big exposure to one company or one bank or one firm, it will be listed in the footnotes. So you can check that and see. You could have checked, and this is, very deep, looking, but you could have looked this asset. Oh, they have big exposure to 3 Arrows Capital. What does 3 Arrows Capital invest in? And they had massive exposure to cryptocurrencies, which would immediately be red flag for me. But that's I don't even know if they included that in their filings. It might have been completely masked. Who knows? And
you're right. These are things that get put down in the footnotes, kind of.
Yeah, and look, that's exactly why I think you don't ever put all of your money in a single investment, even if your thesis is perfect. It's just impossible to know.
There's always risk.
There's always risk. There's things that there's risks in businesses that will not be presented in publicly available information. Fraud. Hidden, the actual value of certain assets that they have, or the value of loans they have. Some of these things are not actually shown, and you sometimes can't. But the things that Brandon mentioned are good ways to just that they're good general ways to, I think,
there's always
move the needle in your direction, I guess, is the answer. There's no perfect. Yep, this company is good to go. There's only you can only try to move the likelihood of that. Of you investing in a bad company, away from you. So
I think probably the biggest, maybe two biggest ways to make sure that your company is going to be okay is they have a decent amount of cash and they simply don't owe anything to anyone.
Yeah.
I think they're the two things.
Yeah, exactly. Yeah.
Then it's I think Peter Lynch says it's very difficult to go bankrupt.
Yeah, they will try.
If you don't owe anything. A lot of companies will try.
Yeah.
But it's very hard to go bankrupt if you just don't owe anything to anyone.
Yeah. Because a lot of companies, they owe money, and then they, as soon as they get into any trouble, they have to think about paying that down. Whereas if they have no debt and they have cash, they can usually ride for a little while, short-term pain, and then they can access equity markets and dilute, which is obviously not good. But it's not immediately like Carnival, which had huge liabilities, and then the cruise lines all shut down, and they had to immediately dilute, just immediately. Yeah. They just had no choice. They had no money.
Under terrible conditions.
At a share price that was down 90%. So it's just, that's what you want to avoid. But yeah, you can only move the needle. You can't, guarantee. So, yeah.
All right, cool. Thanks very much for sending in your questions, guys. Keep them coming. As always, we do have quite a few, which we'll try and get to, as we always say, which we struggle. We just talk for too long. I should have cut the chit chat at the start. But I like having a chat. Yeah, this podcast is kind of like, for me and Hamish, it's also like an hour where we just kind of get to catch up with each other.
It's therapy.
Yeah, like actually, it's like, we talk about the news, or it's a podcast and we put it together, but it's also like our chance each week to actually have a chat with each other. Yeah. So it kind of does drift that way sometimes. But anyway, guys, thank you very much for listening or watching, depending on what platform you're on. Keep the questions coming, as we're saying. But that will just about do us for today. Thank you very much for tuning in. Thanks to Sharesight, as always, for sponsoring. Thanks, Hamish, for joining me, as always.
No worries.
And with that said, we'll see you guys next week.
See you later, guys.